From the farms that feed us, to the oil fields powering our future, to the businesses and innovations shaping tomorrow, Uganda's economy is always moving. Let's dive in and explore the rhythm driving our growth. Welcome to the Blue Pulse.
I think there are a couple of factors to consider. I think obviously first oil will change the dynamics of the trade balance for the current account. So from a current account deficit in 2 to 3 years, we're either going to be running a significantly smaller current account deficit or a small current account surplus. But I think more importantly, into that period, the rest of the economy, such as the agriculture subsector, the industrial subsector, should still get attention. So public policy should still be focused on giving those sectors attention, so you avoid a Dutch disease, moral hazard kind of issue. But one thing that we have to give credit where it's due is the fact that for the longest time, I think until a year ago, Ugandan authorities never really talked about oil revenue or factored it into their budget assumptions. I think it's just the last year or so where we've started to see oil revenue priced into future revenue and how that will kind of play out for fiscal deficits. And I think that was critically very, very sort of crucial, given that the authorities in Uganda in the last decade avoided a situation where they were going to present value future revenue of oil. But I do think that if managed well, and I think it's positive that we've seen the planned formation of the Sovereign Wealth Fund. I think the fact that Uganda models their oil on the Norway case study, I think is also very prudent, very exciting. But yeah, I think in terms of economic growth, you are going to see very stellar growth performances between 7 and 8% into the build-up of first oil and even after first oil, as we see production obviously increase, but then we see investment spending also ramped up. But nevertheless, I think very, very pertinent would be to ensure that the economy remains well diversified, and a lot of the savings or buffers that are accrued from the oil sector, oil investments, are going to continue to go towards sectors that have the ability to absorb labor. Yes, I think you have to think about it in 2 stages. So the initial stage, which we are in right now, which we've broadly been in for the last 5 years, is sort of the investment phase, right? So you're seeing a lot of construction of ancillary infrastructure that would complement the oil story, oil production phase, where you're seeing the airstrips being built, water and sewage treatment around, road construction and the like. And I think that in itself, supports economic activity from an investment standpoint. But when we take a global average, production of oil for most new hydrocarbon producers normally oscillates between 40 to 50,000 barrels per day in its sort of initial phase of the first or second year. In some cases even lower, 25k BPD, maybe 40k BPD. Uganda's peak production is estimated at about 230k BPD, and again, based on global averages, you only see peak production at the earliest being hit in the 5th year, or in some cases the 7th year. So I think even if first oil kicks off by the end of 2026 as we expect, you're only looking at peak production contributing to the fiscus, the balance of payments, around early 2030s. The impact's mostly indirect. I don't think it's very direct from a trade standpoint. Of course, initially with AGOA, we were very concerned about a select few markets, because that was going to be a direct impact on some textile markets or exports as well from an outright standpoint. But I think now it's more about being caught in the crossfires between the US and China, for example, or US and Europe from a global trade war standpoint. And in a way, the last year, this, as counterintuitive as it sounds, could have been a lot worse for many sub-Saharan African markets, but it proved to be very positive because the dollar weakened, and as the dollar weakened, we saw our currency strengthen against the dollar. We saw the interest rates in the US continue to come down. The Federal Reserve was still lowering their policy rate, and that emboldened capital flows back into Uganda, back into Nigeria, back into Egypt, to an extent Zambia and Kenya as well. As counterintuitive as it sounds, global trade uncertainty is at it's at peak highs, not as high as what it was in April last year, but it could have been much worse. One of the aspects that will probably continue to support Uganda in a geopolitically fragmented world is the fact that Uganda still very much has very strong trade ties within the region as well. I think Uganda still trades quite heavily within the region. Of course, there have been some issues in the past with South Sudan, with Rwanda more recently as well in terms of the trade relationship. But again, strong buffers from that standpoint. But I think economically, Uganda, going to benefit from the gold purchase program. I think foreign exchange reserves will continue to rise. I think the oil inflows will support the fiscal balance, will support the balance of payments position, the external position. And I think when you see economic growth getting towards a 7 to 8% level, Uganda will have a kind of natural hedge or natural buffer locally or domestically to be more resilient and weather the storm. Look, I think when you talk about the mineral sector, specifically gold, for example, firstly look at the net value addition of gold. It's not as large as what the absolute export number shows. So exports are in the multiple billions, especially since the government ironed out some of the tax issues with mining firms in the last few years in Uganda. But the net value addition is between $100 to $200 million. But I think the broader benefit will come from the government monetizing these gold exports. And I think in the last few years, even as gold exports have increased, whether the net value addition was only $100, $200 million, we didn't see a foreign exchange inflow benefit for the economy. And now through the Bank of Uganda's planned domestic gold purchase program, which is likely to kick off in the first half of this year, you will see the Bank of Uganda go to some of these artisanal miners, pay them in Uganda shillings, purchase this gold, hold it on their books as either monetary gold or refine it and sell it and still hold dollars in terms of reserves. I think it's hugely beneficial to a story that's already expecting first oil and expecting more inflows. And I suspect what needs to be done is similar to what we've seen in Ghana, where Ghana formed the Gold Board. And even in Uganda, you have a lot of artisanal miners. And when you have sort of the small-scale artisanal mining structure, you need to make sure you streamline the sector to make it more formal. And I think that's a step that the Bank of Uganda is already trying to work around through the formation of cooperatives or working with cooperatives to streamline and formalize some of these artisanal miners or small-scale miners. But clearly, I mean, in addition to the risk of international gold prices falling, I think the other risk is that will gold production or will gold exports continue to increase in Uganda? Now that's the big question, right? And that's the huge risk. So for whatever reason, if gold production, gold exports declines, and I haven't had a look at some of the recent geological surveys, but I think if that is what happens, then the gold purchase program might not be as durable in terms of supporting the external accounts of Uganda and the overall macroeconomic stability picture. So I think with the currency, one of the things that the investment community rightly talks about is the is the credibility of the Bank of Uganda, and I think what contributes to that discussion is the fact that the Bank of Uganda lets the currency act as a proper shock absorber and lets interest rates serve as automatic stabilizers. So the Bank of Uganda has not sold dollars in the market since mid-2022 in terms of intervening in the FX market. So a lot of the spikes that you see in dollar UGX, for example, in April last year or towards November, kind of get amplified because the central bank believes that the fundamentals haven't changed and they wouldn't need to drain their foreign exchange reserves to slow down the depreciation in the Uganda shilling. But from a more idiosyncratic perspective, I think what supported the currency, as you said, into the elections is the fact that globally the dollar was weaker. Foreign portfolio investors came into not just Uganda to buy local assets like bonds and T-bills, but went into Nigeria, Egypt, Zambia, Kenya. And I think in Uganda, what we've seen is a massive increase in offshore holdings of local debt to about $3 billion. And bear in mind, this is a significant share of current foreign exchange reserve numbers. And while that is positive, it also creates the risk of future volatility if all these offshores take out their capital and go back to other markets or run for the hills if they get concerned about the dollar, let's say, potentially strengthening again. And so I think it's critical that we understand that the currency is being supported by these inflows, reserves, accretion has been anchored by these inflows, but at the same time it does create a very high concentration risk. And I think the Bank of Uganda has to continue to organically, whether it's through their dollar purchases or whether it's through other external loans that they receive, continue to build FX reserve buffers, preparing for potentially a day or a month when some of these investors decide to take their money to a different market for a variety of factors. And I think just to emphasize or underscore how this concentration risk is and how worrying it is because between 8 to 10 portfolio investors own about $2 billion of that $3 billion.